If you are new to the world of stock investing, this video will guide you through several important points that can help you get started on the right track. I will begin by explaining 5 core ideas that every beginner should grasp, then move on to additional sections covering common mistakes. First, it is crucial to separate the money you plan to invest from the funds you need for your everyday expenses and emergencies. Recently, many people have been looking at the impressive growth in the US stock market, which often sparks the thought, should I try investing too? While it is natural to be attracted by strong market performance, it remains essential to ensure that you are using surplus money rather than vital household funds. Stock investing always carries a certain level of risk, and you never want to find yourself in a position where you cannot cover your bills or other necessities because you allocated essential finances to the market. By setting aside a specific portion of your income each month into a dedicated investment account, you create a healthy routine that prevents impulsive decisions based on market hype. It also protects your daily financial stability when the market experiences sudden ups and downs. Next, take some time to learn basic stock market terminology. You will encounter concepts such as market capitalization, which is determined by multiplying the share price by the total number of shares outstanding, and the price-to-earnings ratio, commonly called the P/E ratio, which compares a company's share price to its earnings per share. You may also come across dividends, which are portions of a company's profits returned to shareholders, or earnings guidance, which indicates what a company expects to achieve in the near future. Getting comfortable with these terms helps you interpret analyst discussions and financial news with much greater clarity, making it easier to judge whether a particular company might fit your investment goals. Diversification is another principle that can help you reduce risk. Instead of placing your entire budget into a single stock or sector, you can distribute your funds across multiple industries or even different geographical regions. Many investors choose exchange-traded funds, ETFs, because one ETF generally holds a range of stocks offering broader exposure. Diversification serves as a protective strategy if one part of your portfolio experiences a downturn, since other areas may hold steady or even benefit during that same period. It is also helpful to figure out whether you lean toward long-term investing or short-term trading. A long-term investor typically looks at a company's fundamentals, such as its financial stability, product pipeline, or market competitiveness, and holds the shares for months or years. A short-term trader, on the other hand, monitors price swings more closely, and may rely on technical analysis to identify buying and selling opportunities over a shorter time frame. Both approaches have their advantages and challenges, but if you are a complete beginner, long-term investing tends to be less stressful and allows you to build a strong base of knowledge. The 5th essential idea is the importance of ongoing learning and staying informed. Stock prices move for a variety of reasons, ranging from corporate earnings and industry developments to global economic events. By regularly reading financial news from credible sources, you will begin to notice patterns and understand how different factors, such as interest rates or political shifts, might influence market sentiment. Books and online courses focusing on fundamental or technical analysis can also expand your perspective and refine your strategies. Above all, consider testing what you learn through small-scale or paper trading, and keep notes of your decisions so you can track and improve your methods over time. Beyond these 5 basics, I would like to discuss a few common mistakes that many beginners make when they first start out. One frequent error is relying purely on hype or secondhand information without doing any personal research, which can result in buying stocks that do not align with your goals or risk tolerance. Another pitfall is overreacting to everyday price fluctuations, which can lead to panic selling or chasing rapid gains. Stepping back to examine why a company's share price is moving allows you to invest more logically instead of following headlines or rumors. It is also worthwhile to address how to open a brokerage account and place your first trades. Many online brokerages have intuitive platforms or mobile apps that walk you through the registration process. You generally need a form of identification and a linked bank account to fund your investments. After funding your account, you will choose between order types such as market orders, which execute at the current price, and limit orders, which execute only if the price meets a level you specify. Familiarity with these basic functions will help you trade with more confidence once you begin. Economic indicators play a significant role in market behavior, and understanding their impact can keep you better informed about why stocks sometimes rise or fall following certain announcements. Changes in interest rates, for instance, can affect a company's cost of borrowing and may also shift investor attention to or away from the stock market. Other factors such as consumer spending data or the overall rate of inflation can either stimulate or dampen market optimism, depending on how traders interpret the results. If you're looking for a simple way to create your initial portfolio, you can divide your investment capital among different types of stocks or ETFs. One portion might include stable, well-known companies, another could focus on more growth-oriented picks you have researched, and yet another might go into index tracking ETFs. The specific distribution is entirely your choice and should match your risk tolerance and financial goals, but the idea is to avoid depending on just one stock or industry. In closing, I would like to briefly address a few questions new investors often ask. One question is how much money a person needs in order to begin investing. The good news is that you can start with even a modest sum and scale up as you grow more comfortable. Another common query is whether it is a good time to invest, which ultimately depends on your personal financial situation, market conditions, and your investment horizon. Finally, people frequently ask which stock is the best. There is no single correct answer, as different companies suit different objectives, and that is why it is so important to maintain a long-term perspective, engage in thorough research, and keep refining your strategy. I hope this discussion has given you a clearer understanding of how to start investing wisely and protect yourself from unnecessary risks. While there is no way to guarantee profits in the market, informed and disciplined decisions can increase your odds of success over time. If you found this video helpful, please consider liking and subscribing for more tips, company breakdowns, and market updates. Thank you for watching, and I look forward to seeing you again soon. Until then, stay curious, and keep investing in both your knowledge and your future.